If you ever wanted to know what makes Warren Buffett one of the greatest investors of all time, stay tuned. I'm Dan from the Investment ABC, and in this video I'm going to tell you some of Warren Buffett's secrets to becoming an exceptional good investor. The list is long, but listening to the end will help you to internalize his habits and strategies. I will also tell you which of his habits helped me the most to become better in my investment decisions. Here we go. Warren Buffett rule number 1 is plain and simple. Don't lose money. Warren Buffett is playing the investment game very defensively. He is not sprinting but running a marathon. Think about it. If you lose 50% of your capital in a bad investment, you need to gain 100% to break even. Investing is a long-term game while trading is a short-term game. Buffett likes to hold his shares forever and reinvest the dividend payments to use a compounding effect. Many new investors confuse trading with investing. So be conscious of your goals when picking a stock before you buy it. Warren Buffett rule number 2 is don't forget rule number 1. Rule number 3, don't buy a stock, buy the whole business. When considering buying a stock, you have to find the fair, or like Warren Buffett says, intrinsic value. The best approach is to first find the intrinsic value and then check the price and compare the two metrics. Always write on a piece of paper the reasons for buying the stock for the price of X dollars. If you don't come up with good reasons, pass. Warren Buffett is comparing a certain stock he plans to buy to a stock he already knows very well and asks himself which one is lower compared to its intrinsic value. Even when Buffett is thinking about buying his own Berkshire Hathaway stocks back, he determines the intrinsic value and compares it to the current market price. When his company has enough cash it doesn't need to deploy otherwise and the intrinsic value is less than the current market price, he advocates a stock buyback. Rule number 4. Be patient and be even more patient. Warren Buffett is giving an analogy to a baseball player who is looking for the right ball to hit. Don't swing at everything, wait for the perfect pitch and hit as hard as you can. You don't need to find every month a stock to invest. 1 to 2 good stocks every year is more than enough. According to Buffett, you don't need to be smart to be a good investor. What you need to have is discipline. For me, doing nothing was the hardest thing to do. Only when I mastered sitting still and to wait for the right pitch, I made a leap forward in my game. It is all about changing your mentality so you don't put yourself under pressure to do something at all costs. This mentality will not only help you to be more successful in the investment world, but also to win poker games. Rule number 5. Stay away from the hype of the media and think of it as noise. Most information or so-called news are outdated and plain misleading. You don't need to buy the latest stock in a hyped industry like for example the cannabis or vegan meat industry. Warren Buffett said once, you can't buy what is popular and do well. And most of the time that is right. If you buy into the hype, chances are high that prices are already sky high and you are the last backholder. Instead, check industries that are not that popular at the moment but also not dying and look here for undervalued companies. You will find out that you are looking in the wrong industry when even the best management can't help the company. At that time, it is wise to admit your investment mistake and cut the losses. Rule number 6. Warren Buffett hates gold and Bitcoin because these assets don't produce anything, and he is also not a fan of cash either. Cash is losing its value day by day. Nevertheless, you always need it to buy good companies at bargain prices when you can. According to Buffett, there are times when it rains gold and you need to make sure to have a big enough bucket outside. This happens during a recession when companies lay off employees and profits decline. At that time, the mainstream media is spreading fear and panic and investors plan to run for the exits first before everyone else does. Shortly after prices begin to sink slowly, people think it's just a correction before the decline continues further. Margin calls are being triggered and the decline leads to a full-on crash. I have a feeling Buffett is smelling rain right now since his cash bucket is worth 128 billion at the moment. I think this is the highest cash position Buffett held so far, and I'm very confident he will be able to use it in the next 18 to 24 months. His quote, be greedy when others are fearful and fearful when others are greedy is legendary and a perfect guide during that time of turmoil. Rule number 7. Only invest in what you understand. If you don't understand the business model, don't invest in stock only because it is going up in value or because the media touted it as the next big thing. It is way riskier to diversify into 10 companies you don't understand than to own one stock you have fully understood. According to Buffett, risk comes from not knowing what you are doing. As a private investor, you don't have the pressure of a hedge fund manager to perform no matter what, so take your time and be patient. Warren Buffett did not like to invest in tech companies because he didn't understand them, and although he missed Amazon, Microsoft or Google, he did very well with his stock picks. The key to his success is patience and discipline and holding on to a strategy that is working for him. Rule number 8. Invest in yourself. This will help you to understand different business models. Read as many books on investing as possible, learn how to read balance sheets, and try to learn patience and discipline. No one can steal from you what you have in your brain. Even if you lose all your wealth, you have the tools and ability to gain it back. I know it is hard to read investment books when you have a regular 9-to-5 job, but it really pays off when you want to start investing. Investing is one of the few ways you can escape the rat race once and for all. Rule number 9. When Buffett is looking for stocks, he has 3 main criteria which the company needs to fulfill. First, the management needs to be vigilant and honest, since the top management influences all other aspects of the company. Buffett doesn't need to talk directly with the management to be able to judge them. Most of the times, he just looks at the past track records, how much the salary is and how much debt the management accumulated so far. Good for all investors because we all can do that with the right due diligence. Second, the stock must be stable, understandable and have a long-term prospect. You have to have a high probability that the company still exists in 20 to 30 years and be able to forecast future earnings as accurate as possible. If the stock increased earnings and dividends for the last 20 years, chances are good that they will do so in the future. Third, invest in stocks with an attractive intrinsic value. If you pay attention to these 3 rules, it increases your chances to avoid investment failures. Buffett Rule number 10. Don't invest in IPOs. Warren Buffett said he never invested in an IPO. I think he might see investing in IPOs as gambling because there isn't enough reliable data to judge whether the company will be successful or not. He is conservative and rather sticks to rule number 1. If you have invested in Uber, Lyft, WeWork or NIO this year, you know why he is avoiding the IPO space. I hope you learned from Buffett as much as I did and apply those strategies in your investment decisions. Even if Warren Buffett is one of the greatest investors of all time, you have to develop your own investment strategy which is working for you. You may have a totally different character to Warren Buffett or me, so you need to adjust those strategies to fit your own character and style. If you just blindly follow and buy what Buffett buys, you shouldn't be surprised not to outperform the S&P 500. Since Buffett's company is so big, it is very hard for him to invest in smaller stocks, something which might be perfect for you. I, for example, think it is wrong not to invest in tech companies only because the industry is changing fast. The only problem with tech stocks are that it is harder to find those companies with a big enough moat, but it is not impossible. Even Warren Buffett adjusted his strategy and bought Apple and Amazon, although they are tech companies. So make sure to find out what is working for you best too. If you like this video, please like, share with friends who like to learn how to invest and subscribe for future videos. Also, comment if you think Buffett's decision to buy Apple and Amazon will pay off in the future. Bye and hope to see you in the next one, guys.